Xiaomi is a global technology powerhouse, really dominating the smartphone and IoT markets. And now, well, they're aggressively jumping into the electric vehicle, or EV, space. I mean, for a company that's already the world's third largest smartphone brand, what is it, 13.8% market share globally? This pivot isn't just, adding a new product. It feels like a massive, really highly capitalized strategic transformation. Today, we are taking a deep dive into Xiaomi Corp. We're focusing on its stock performance and these huge shifts that seem to be underpinning its valuation. I mean, we are looking at a company that has seen its stock rally. It's, what was it, a staggering 288% over the last 12 months.
Yeah, that's an eye-watering number, absolutely. It tells you everything about the market excitement, doesn't it? But our mission today is, well, to figure out if that rally is truly justified. We'll be trying to cut through the noise using the latest Q2 2025 financial results, focusing on their, let's say, ambitious strategic outlook, especially the aggressive EV delivery targets, and crucially, the timeline for profitability. And then we'll see how the market is actually translating all this into valuation metrics.
Right. So we're not just reading a balance sheet here. We're analyzing a complete strategic makeover. And it seems anchored by this strategy they call premiumization across, well, pretty much every single product line they sell.
Yeah.
Okay, let's unpack this transformation. We should probably start with the foundation, that Q2 2025 financial snapshot. We need to see if the core business is, stable enough to support this huge EV gamble.
Absolutely. That's the place to start. So when we look at the core financials from Q2 2025, the overall performance was undoubtedly robust. It definitely exceeded consensus expectations from groups like Mirai Asset. Total revenue expansion surged 31% year over year. That puts it around CNY 115.9 billion based on the different estimates floating around.
Okay, 31% revenue growth is impressive for a company this big. But that operating profit expansion? That seemed really startling. It suggests some strong operational leverage might be kicking in.
It was a massive indicator of health, exactly. Operating profit surged 128% year over year. I mean, that kind of triple-digit earnings growth is what really grabs investors' attention, especially because, remember, Xiaomi has been in heavy capital expenditure mode to launch the EV business. So this tells us they're managing these high-growth investments while simultaneously expanding their profitability quite dramatically.
Okay, so if the overall numbers are soaring like that, let's look under the hood a bit. The segment drivers. This is where the nuance comes in, right?
Yeah.
Because the different parts of the business seem to be moving in completely different directions.
They really are. You take the legacy core smartphones that actually saw a 2% decline in revenue year over year in Q2 2025.
Only 2%, but still a decline.
Yeah, a decline nonetheless. And it was attributed to, well, weaker than expected global demand generally, combined with some pretty aggressive competition from major rivals. It sort of signals that if Xiaomi had just remained a smartphone company, that, 288% stock rally probably wouldn't have happened. The core phone business is definitely under competitive pressure.
Right. And that pressure makes the success of the other segments even more critical. The IoT and lifestyle products segment. That seems to be where the ecosystem effects are really starting to generate serious cash.
Oh, that segment is booming. IoT and lifestyle sales soared 45% year over year. And what's driving this isn't just, smartwatches or fitness bands anymore, it's the high-value home appliances. For instance, in Q2 2025, their air conditioner shipments jumped 60% year over year to 5.4 million units. Washing machines were up 45%, refrigerators climbed 25%. It really shows that once a consumer enters the Xiaomi ecosystem, maybe through a phone, they are actually buying major, high-margin, high-value appliances. That's exactly what a mature ecosystem is supposed to do, right? Generate that follow-on business.
And then we have to factor in the EVs segment. I mean, this didn't even exist in 2023.
Yeah.
So while the Q2 2025 results were maybe primarily driven by that huge IoT momentum, the EV division must already be generating significant revenue.
Absolutely. Beansprout noted the EV segment generated RMB 9.7 billion in revenue back in Q3 2024 alone. That's a completely new, multi-billion RMB revenue stream added essentially overnight. It just changes the entire scale of the enterprise. And importantly, the overall company gross margin stood around 22.5% in Q2 2025. That's a pretty healthy margin, demonstrating they are balancing this aggressive market entry like with the SU7, while still maintaining overall profitability.
Okay, that foundation looks solid. But now we have to connect that rapid growth to the stock's current valuation. Because, given that 280% rally, you might expect the stock to be priced for absolute perfection. Let's look at the key valuation metrics. Maybe start with the trailing 12 months or TTM price to earnings ratio, the PE.
Right. So as of early October 2025, the current TTM PE ratio is 33.72. This is based on a share price around $33.65 and TTM diluted EPS of $1. And this is where the story gets a bit counterintuitive, actually. Despite that massive rally, that 33.72 PE is, well, quite close to its one-year low of 32.77.
Really? Close to the low.
Yeah. The volatility, or perhaps the market's reluctance to just let the multiple run away completely, seems to be keeping it somewhat anchored.
Interesting. So if we look back over, say, a decade, how does that current TTM PE stack up against their long-term history?
Well, the 10-year median PE for Xiaomi is 31.92. So this is the first kind of surprising insight for you, the listener. On a basic TTM earnings basis, Xiaomi is currently trading very close to its long-term average. The market hasn't, dramatically expanded the multiple for the stock as a whole yet. Not on that basic PE measure anyway.
But we know earnings can be volatile, right? Especially with non-recurring items or NRIs fluctuating wildly. For the listener who might not track these metrics daily, can you just quickly explain why stripping out those non-recurring items is such a critical step? Especially when you're judging the underlying health of a volatile transforming business like Xiaomi.
Yeah, it's crucial because NRI, things like one-off asset sales or maybe massive write-downs or restructuring costs, they can really distort the PE ratio. They can make a company look artificially cheap or expensive in a given period. By removing them, we get the PE without NRI, and that reflects the recurring core operational profitability. It's arguably the truer, more stable measure of what the market is really willing to pay for Xiaomi's ongoing earning power.
Okay, got it. So what is that more stable metric, the PE without NRI? Tell us then.
Okay, so the TTM PE without NRI is 42.81. Now here's the key takeaway. This number is almost identical to the 10-year median PE without NRI, which is 42.74.
Wow, so identical.
Pretty much. This strongly suggests that despite the hypergrowth in the stock price and this aggressive strategic shift, the market is currently valuing Xiaomi's normalized earnings exactly where it historically should be valued. It indicates investors are not paying some excessive premium for the current level of normalized earnings. Instead, they seem to be strictly pricing in the massive acceleration of growth. And we can really see that when we look at the earnings growth rate itself.
Wait, let's talk about that velocity, because this must be the number that justifies that huge stock move.
Absolutely. High velocity is the term. The average EPS without NRI growth rate over the past 12 months was, explosive. 167.3 lever percent per year.
167%, okay.
Yeah, that is what's funding the 288% stock rally. But if you smooth that out, look longer term, the 5-year average EPS growth rate without NRI was a more moderate 16.62% per year. So the market is aggressively betting that this 167% hyper growth driven by the EV and IoT transitions is effectively the new normal. It's betting that this pace permanently replaces that slower, 16.6% trajectory.
Makes sense. And finally, just quickly, let's check the balance sheet health, because they are in this massive capital expenditure phase, launching cars, building out retail stores.
Yeah.
They must have robust liquidity to pull this off without, raising huge amounts of dilutive debt or something.
Oh yeah, the balance sheet looks like a fortress. Despite the enormous capital expenditure required for the EV launch and all the R&D, the company reported a massive cash balance of RMB 151.6 billion as of Q3 2024. And what's really impressive is this was an 18.7% year-over-year increase in cash. So they definitely have the financial muscle to execute this complex, enormous pivot.
And what about the price to book value, the PB? We see some variation in analyst estimates there, kind of ranging from 4.5x up to maybe 5.9x for FY25 estimates. What does that range signal?
Well, that range signals a really strong belief in the future growth potential, something far exceeding the historical sort of accounting value of their assets. A PB over 4.0x generally indicates the market is willing to pay 4 or 5 times the liquidation value of the company's physical assets. Why? Because the intellectual property, the brand recognition, and those future growth engines, the EV platform, the AIoT ecosystem, are valued so highly. The market clearly sees Xiaomi as a high-growth tech platform now, not just, a hardware manufacturer.
Okay, so that financial health gives them the runway. Now here's where it gets really interesting, I think, the strategic outlook. And it seems centered almost entirely on the electric vehicle business as the new massive growth engine.
Yeah, this is definitely the bold move. Management has put an extremely aggressive target out there for 2025. They're maintaining their guidance of 350,000 unit deliveries for the year.
350,000,
Right.
just to put that in perspective. That's approaching the volume of some established global EV players, right?
Yeah.
And they're aiming for that in their, first full year of operations?
Exactly. It's incredibly ambitious, but, the launch performance of the SU7 model has definitely lent some credibility to that ambition.
It has been pretty successful, hasn't it?
It's been an astounding success, yeah. The SU7 achieved 76,000 unit deliveries just in Q1 2025, and it became the fastest EV model globally to reach 100,000 production units since its launch, hitting that milestone in just 230 days. This proves two things, I think. One, overwhelming customer demand, probably fueled by that brand loyalty from the phone division, and two, exceptional rapid production ramp-up speed. They seem to be replicating the supply chain mastery they demonstrated in smartphones.
Okay, volume is great. But as we know in the EV race, volume often means negative margins, at least initially. The million-dollar question, or maybe the $3.5 billion R&D question is, when does this EV division actually turn a profit?
Well, management is remarkably confident on this point. They are guiding for the EV business to turn profitable in the second half of 2025, so quite soon. And this expectation seems to be underpinned by the rapidly improving gross margin within that EV segment itself. Apparently, it surged to an incredible 26.4% in Q2 2025.
Wait, 26.4% gross margin?
Yeah.
On a brand new EV line? That sounds staggering. I mean, for context, many established automakers struggle to hit double digits in their EV divisions. How is Xiaomi achieving such high margins so quickly?
It seems to be a direct result of applying their signature philosophy, that affordable with premium features model coupled with, hyper-efficient component sourcing and integration, leveraging their existing scale. The SU7, priced around $30,000, it's disrupting the market while simultaneously, it seems, maintaining margins better than many legacy players who are still dealing with high legacy costs. They're likely leveraging their scale as the world's third largest phone manufacturer to negotiate better deals on components that overlap with EV production, things like screens, internal electronics, maybe even some sensors.
Okay, so production and pricing are key. But they're also investing heavily in R&D. That seems aimed at maintaining some kind of technological moat, right?
That's where that RMB 3.5 billion R&D investment comes in. They're clearly not just outsourcing the brain of the car. Their focus is very much on smart EV R&D, specifically next-generation autonomous driving. They're talking about building full-domain, end-to-end models, integrating high-end hardware like LiDAR, 40mm wave radar, and powering it all with massive, seemingly in-house developed 700 teraflop computing power. They really aim to be a software company that happens to make cars, not just a car company using off-the-shelf software.
And this ambition isn't just limited to the domestic market in China, is it?
No, correct. The global ambition is already defined. They apparently plan to enter the challenging, highly regulated European EV market by 2027. This really signifies that the EV division is viewed internally as a pillar of global expansion, just like smartphones and AIoT were perhaps a decade ago.
And when we talk about the total addressable market, the TAM, this EV pivot, fundamentally changes the math for Xiaomi's potential scale.
Completely. The global EV market is valued at roughly $500 billion. Now, compare that to their traditional core markets, smartphones around $600 billion, maybe home appliances around $743 billion globally. Entering the EV space expands their opportunity vertically. It allows them to leverage that massive existing customer base you mentioned, 500 million connected devices, to drive incremental revenue in a market that is still growing rapidly. It secures a revenue source they simply couldn't access before.
Okay, so the EV story is huge. But while EV is capturing headlines, they obviously can't afford to let their core business decay. The strategy to strengthen the core seems to revolve around this idea of smartphone premiumization. They're actively trying to shed that image of being purely a budget brand.
Yeah, that pivot is essential if they were margin expansion, and market data actually supports this shift. Premium smartphones, let's define those as price above, say, RMB 3,000, which is roughly 470 US cents, now account for 21.3% of the China market, looking at data from 2024. So this trend favors Xiaomi's new focus. For 2025, their targets are pretty specific. Aim for a 1 percentage point market share gain overall, targeting 175 to 180 million unit shipments globally.
And critically, they're aiming for an average selling price, or ASP, hike of 3% to 5% year over year. Now, that ASP hike must be managed carefully alongside maintaining a healthy smartphone gross profit margin, which they're targeting between 12.0% and 12.5%. That's a tricky balance.
Exactly. It's very tricky. And to support that premiumization and the ASP increase, they are executing this massive new retail strategy. It focuses on online and offline integration. Their long-term goal here is kind of staggering: 30,000 stores in China and 10,000 stores overseas. A significant physical retail presence is really indispensable for premium sales, right? Because consumers want to touch and feel and experience a flagship product before spending, say, $1,000 or more.
Makes sense. Now let's jump to the AIoT ecosystem, that sort of invisible thread connecting everything Xiaomi does. The scale here is arguably their strongest competitive advantage, their moat.
The scale is immense, yeah, and it's still accelerating. The AIoT ecosystem connects over 500 million devices globally now. This creates a really powerful and sticky network effect. It drives customer loyalty and, crucially, generates that high-margin internet services revenue. And the targets reflect this importance. They're aiming for 30% plus year-over-year sales growth in AIoT in 2025. This is fueled by those major appliances we discussed earlier, and also aggressive overseas expansion, particularly targeting Europe in the second half of the year.
And they expect the AIoT gross profit margin to improve too, by 2.0 to 2.5 percentage points. If they can actually achieve margin expansion across all three key segments, EVs, premium smartphones, and AIoT, that would dramatically validate the whole premiumization strategy.
Right. And that potential margin improvement links directly back to their self-developed AI and chip strategy. That seems to be the technological anchor of the entire ecosystem. Xiaomi has apparently been quietly investing in AI technology since way back in 2016. They are not relying solely on external chip manufacturers like Qualcomm or MediaTek for everything. Their R&D is focused on building large language models, LLMs, tailored specifically for their ecosystem, and also developing next-gen NPU chips, neural processing units. They even cited a specific 6-core NPU architecture they're working on.
So this is really about vertical integration then, ensuring they control the silicon that runs the brain of the ecosystem. That seems crucial for cross-platform synchronization and unique features.
Precisely. These self-developed chips are designed explicitly to bridge all their platforms. They'll be in flagship smartphones, enabling advanced AI features. They'll be in the smart EVs, powering things like visual LLM-assisted driving. And they'll even be in home appliances, for example, enabling 40 millimeter wave radar perception, perhaps in air conditioners for smarter, more personalized operation. This control over silicon and software is likely how they plan to differentiate themselves from competitors like Samsung and Apple, tying that whole 500 million device ecosystem together more seamlessly.
Okay, zooming out a bit now, let's tie all this strategy together with the high-level 2025 corporate guidance, because the market is clearly betting heavily on these numbers being achievable.
Yeah, management guided for group revenue growth of 30% plus year over year for 2025, and perhaps even more importantly, adjusted net profit growth of 40% plus year over year. Now, hitting 40% profit growth while executing a simultaneous multi-billion-dollar EV rollout, that would really solidify their transition into a genuine, highly profitable tech conglomerate.
So, based on that guidance, what's the strongest argument supporting that HK $65 price target we've seen mentioned by some analysts? How do they justify that?
Well, analysts seem to argue that the comprehensive strategic AI integration, specifically the use of their AI assistant across all devices, combined with the, superior growth potential in EVs and AIoT, justifies a significant multiple expansion. The implied target PE expansion to maybe 30 to 35x is seen as fair, reflecting that superior growth relative to peers. At the end of the day, the growth story is the justification for the higher valuation target.
Okay, but rapid transformation and aggressive global expansion are inherently risky. We need to spend a bit of time on the key negative factors, the risks that could derail these really ambitious targets, starting with those persistent geopolitical headwinds.
Yeah, geopolitical risk is critical. It's sort of non-negotiable for any Chinese technology company with global ambitions these days. US-China trade tensions, regulatory risks, they're always a shadow hanging over Xiaomi. We need to remember they were temporarily blacklisted by the US back in 2021, so any future US export curbs, particularly regarding advanced chip production, which is vital for their NPUs and EVs, or maybe data sovereignty concerns cropping up in Europe, these could severely impact their ability to sell or operate globally. A sudden regulatory shift could potentially cut off significant portions of their overseas revenue stream, which is crucial for hitting that 30% plus AIoT growth target.
Right, that's a big external risk. And the second major risk seems more internal, relating directly to their aggressive growth pace and the need to stock up on hardware to support that 350,000 EV target and 180 million smartphone shipments. You mentioned inventory management earlier.
Yes, this is potentially a huge operational issue. Their aggressive expansion apparently resulted in $2.8 billion in unsold inventory as of Q1 2025, and that was up 22% year over year. So we kind of need to debate what this signals. Is it just strategic preparation, stocking up on chips and components to ensure they can hit the massive 2025 volume targets regardless of supply chain shocks? That's the positive spin.
Right.
Or is it a major red flag? Does it indicate overconfidence where they perhaps overestimated consumer demand, particularly in maybe lower margin smartphone markets?
And if it's the latter, if demand slows down unexpectedly, what's the pressure point? Where does that hurt them?
Well, inventory overhang forces liquidation and markdowns. That's the classic problem. And markdowns directly pressure the very margins they were working so incredibly hard to improve across the board. If they have to suddenly dump $2.8 billion worth of products at heavily discounted prices, that completely contradicts the entire premiumization strategy we talked about. And it directly threatens their guided 40% plus adjusted net profit growth. It's a really delicate balancing act between preparing for massive growth and avoiding a margin-killing inventory crisis.
Okay, so given this complex risk-reward profile, you've got this massive growth pivot colliding with these significant operational and geopolitical headwinds. Let's look at how the professional investment community is currently pricing the stock. Starting with the broker consensus, what are the analysts saying?
Well, the overall analyst consensus is remarkably positive, actually. It's rated a strong buy. And this is based on a poll of 38 analysts, which shows nearly unanimous institutional support. You've got 32 recommending buying, 4 recommending holding, and only 2 suggesting selling. So very little professional dissent right now regarding Xiaomi's trajectory.
And what does that strong buy consensus translate to in terms of actual price expectations?
The average 12-month price target from those 32 analysts is HK $65.91. Now, considering the current price is around HK $51.80, that represents a potential upside of over 27% from the current level. And some specific high targets are even more bullish. You see CLSA at HK $69, Goldman Sachs at HK $66. So strong conviction there.
Right. Let's go back to that valuation disconnect we talked about earlier.
Yeah.
If the normalized PE is kind of anchored near the 10-year median around 42x, how are analysts justifying adding another 27% upside to the stock price? They must be valuing that growth segment, the EV part, exponentially higher.
Yeah, they are, exactly. The justification largely comes from using a sum of the parts, or SOTP, valuation approach. This approach basically values the mature business like smartphones and the AIoT internet services separately from the high-growth, potentially high-multiple venture, which is the EV division. And critically, analysts like CMB are assigning the nascent EV business a value of 2.0x FY26 estimated price to sales. So 2 times future sales.
Okay. So that 2.0x price to sales multiple in the EV business, that's where the significant growth premium is really being baked in. It means analysts are projecting not just that Xiaomi will successfully launch 350,000 cars, but that the market will value the EV unit similar to, say, pure play high-growth EV startups rather than just a division within a diversified conglomerate.
Precisely. That's the bet. Furthermore, analysts are justifying the overall implied target multiple for the whole company around 37.7x FY25 estimated PE by using peer comparison. They note that this multiple is justified relative to the industry leader, Apple, which trades around, say, 34x FY25 PE. Why the premium over Apple? Because Xiaomi, arguably, has significantly faster growth rates projected and much greater momentum in these critical new fields of AI and electric vehicles than its more established competitors. They are pricing Xiaomi as a future-focused, growth-accelerated premium tech player.
Okay. And this shift in perception is definitely visible on the stock chart itself.
Yep.
That 288% rally is just massive evidence of that.
Oh, the momentum is undeniable. The stock has absolutely outperformed, seeing that massive 288% rally over the past 12 months. It's blown past the performance of the general Hang Seng Index in Hong Kong. This sustained upward trajectory indicates strong, committed capital inflows that are specifically targeting the Xiaomi growth narrative, largely based on that EV announcement and initial success.
And where does the current price, around HK $51.80, stand in relation to its recent extremes? Is it near the top?
Yes, the stock price is currently trading very new its 52-week high, which was HK $61.45. And it's important for you, the listener, to remember that the stock came from a 52-week low of just HK $22.50. So the chart visually tells the story of an explosive market repricing based entirely on this strategic pivot. Now, when a stock trades near its high after such a massive rally, it suggests the market sentiment remains highly bullish, but also potentially quite sensitive to any negative news or disappointment.
Right, makes sense. So what key technical and fundamental catalysts are analysts watching for next? What are the specific upcoming events or data points that could drive the stock past at that HK $65 average price target?
Broker analysis points to several critical events coming up. We need to watch for the launch of new EV models, specifically an SUV is expected, which would broaden their consumer base significantly. Continued, confirmed market share gains in both smartphones and AIoT are vital to show the core is healthy. We need progress reports on that overseas store expansion. Are they hitting their targets? But probably the most important catalyst, the one that could cause the next leg up or potential multiple expansion, is the critical update on EV orders, deliveries, and, most importantly, the confirmation of profitability in the second half of 2025. If they confirm that EV profitability target is on track, the stock will likely leap beyond the current consensus targets. That's the big one.
Okay, this has been an incredibly detailed and really fascinating deep dive. So to recap, Xiaomi is actively, and it seems, successfully transitioning from being primarily a high-volume smartphone company to becoming this complex, multi-ecosystem tech powerhouse. They're leveraging their core strengths, cost leadership, supply chain mastery, advanced AI and NPU development to fuel massive growth in both the high-margin AIoT segment and, more dramatically, the electric vehicle sector. And this is all supported, at least so far, by impressive Q2 2025 results.
Exactly. And the 2025 guidance is the target the market is laser focused on. 350,000 EV deliveries, achieving a profitable EV segment by the second half of the year, and hitting overall group-adjusted net profit growth exceeding 40% year over year. And we learned that, somewhat counterintuitively, the market is currently valuing Xiaomi near its historical PE median based on normalized earnings. This suggests the current valuation primarily reflects the existing proven growth, perhaps not yet a dramatic expansion in the multiple itself.
Right. So the central question for you, the investor, now becomes quite complex. The stock has rallied an incredible 288%, but the core normalized valuation remains kind of anchored to its historical median. Given that the market is currently pricing the entire future based on the success of this EV pivot, and that promised 40% plus profit growth, a promise that, as we discussed, could potentially be broken by geopolitical tension or that maybe worrying $2.8 billion inventory level, you really have to ask yourself, is the current valuation truly reflecting the speed and the potential scale of this transformation into a major EV and AI device player? Or is that anchoring near the median PE a subtle sign that the market is still deeply pricing in the significant risk of failure? The risk they might not execute on those extremely aggressive second half 2025 targets.
That is the complex dilemma, the key question facing Xiaomi shareholders and potential investors today.
Well, thank you for joining us for this deep dive. We really hope this comprehensive analysis gives you a far better understanding of what's driving this major shift in one of the world's largest and most dynamic tech companies. Finally, if you have any other stocks you'd like us to cover in this kind of detail, please let us know in the comments. Don't forget to like, share, and subscribe. Thank you,